Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your May 2020 market update. Well, domestic stocks, as measured by the S&P 500 index, advanced 4.76% in the month of May, as the market continued to claw its way back from the calamity experienced during the first quarter. Investors continue to grow optimistic regarding the potential for a COVID-19 vaccine, as well as the resumption in economic activity as stay-at-home orders and business closures are relaxed. Despite the unprecedented decline in the U.S. economy that is still unfolding, the S&P 500 index is down only 4.97% year to date, and so it's really clawed back a lot of those losses that we experienced during the first quarter of this year. As I've stated in my last few market commentaries, large cap stocks, the yellow bar there, have been leading the advance by a wide margin. The advance of the S&P 500 has been largely concentrated in only a few sectors that benefited from stay-at-home orders, such as technology, and also there are several names in the index which have also benefited the market greatly. Small cap domestic, the red bar there, international developed and emerging market stocks, they still remain down anywhere from 14% to 16% year to date, so they have not recovered as much as the large cap domestic sector has. The commodity index, the green bar there, the commodities are down 21.2% year to date. And on the bond side, domestic investment grade bonds, those are the highest quality bonds that are issued by U.S. entities. That index is up 5.47% year to date, again demonstrating the benefit of diversification within a portfolio, having some bonds in a portfolio to help balance some of those returns. Other areas of the fixed income market have not held up as well. The high yield bond index as well as the emerging market bond index are both down around 6% year to date. So again, we're seeing very wide dispersion in terms of what sectors are outperforming, what asset classes are really clawing back some of those losses year to date. So I want to give you an update on where we are and what we're seeing in terms of the economy. A summary of recent economic data shown in this chart really demonstrates a disconnect between the stock market and the economy. The coronavirus-induced lockdown continues to exact a heavy economic toll, causing unemployment to at least temporarily rise to levels not seen since the Great Depression. GDP, which is short for gross domestic product and is a measure of the goods and services produced in the economy, was down 5% in the first quarter and is likely to have its sharpest contraction ever recorded in the second quarter, with forecasts of a 30 to 40% decline in GDP. We've had the biggest drop in manufacturing since the global financial crisis. Business leader confidence is also at very low levels, and earnings are expected to decline by over 20%. And so when you're looking at the economic data, you're getting a very different picture than what you're seeing in the market. One of the ways we kind of put all the economic data together is by looking at something published by the Conference Board called the Leading Economic Index, or LEI. This index is comprised of 10 different economic components whose trend tends to precede changes in the overall economy. So you look back at those gray shaded areas there in 2001 and 2008 time period, you can see that blue line, the leading index, rolled over and started to decline before a recession hit. And so we typically look at the LEI for an indication that something is changing in the economy. Well, since this was an exogenous shock to the market, the LEI fell off a cliff during this latest pullback for the economy, and it posted its largest decline in its 60-year history in March. And according to the latest release from the Conference Board just a few days ago, they said that the sharp declines in the LEI suggest that the U.S. economy is now in a recession. Business conditions may recover for some sectors and industries over the next few months, but the breadth and the depth of the decline in the LEI suggests that an imminent reopening of some sectors does not imply a fast rebound for the economy at large. So what we have right now at this juncture is we've had quite a rally off the lows in large cap domestic stocks, but the economic data is telling us a very different picture of what's going on, and it is implying that the rebound it's probably not going to be a V-shaped rebound in the economy like we've seen in the stock market. It's going to take quite a while to get back to where we were. And so I wanted to show you where we are now in terms of valuations for the stock market. By valuations, what I mean is that if something is overvalued, that means it's expensive relative to what it's worth. And if it's undervalued, that means it's cheap relative to its intrinsic value. And so we look at valuations just to gauge the riskiness of investing in stocks versus bonds in different areas of the stock market at a given time. And this chart shows that stock market valuations look lofty by many metrics. The main graph here shows the forward price to earnings ratio on the S&P 500 index. And what you can see here is that we are well above the 25-year average. So your 25-year average there is the average price to earnings ratio that you have over a 25-year period. And right now we're at levels not seen for almost 20 years. So one way of looking at this is that if you are starting to invest in large cap domestic stocks right now, you're paying much more given future expected earnings if you invest today than you were at any time since, the 2001, 2002 time period. Now, that being said, that is just one measure of valuations. In the upper right-hand part of the chart there, you can see there are many different ways to measure valuations on the market. The price to earnings ratio, which is what's shown on this chart, is very overextended. But if you look at other measures such as the CAPE ratio or dividend yield or price to book, they're not as overvalued as the price to earnings ratio would suggest. But overall, the readings are coming in that given what we expect earnings to be in the stock market, and again, what earnings are, that's how you make money in the stock market. You get a share of those earnings as profit as an investor. They are fairly lofty compared to where we were historically. And so I do think that the market has probably gotten a bit ahead of itself here. Now, one bright lining in this is that the last valuation measure there, the earnings yield spread, that's really a measure of the valuation of stocks versus bonds. And because bond yields are so low right now, stocks still look attractive relative to bonds. So kind of the way to think about this is stocks look attractive relative to bonds, but they don't look attractive relative to where you could have bought them throughout the last 15 to 20 years of market history. So all that being said, I would be remiss if I did not mention that the stock market is anticipatory, meaning that it moves based on expectations by pricing securities based on expected future cash flow. And equity markets on average peak and trough approximately 6 months in advance of peaks and troughs in the economic cycle. And so the swift recovery in equity prices that we've seen since late March implies that investors expect that the economy will bottom relatively soon. That would be, in about 3 to 4 months if you're going on that traditional 6-month time frame. And there has been evidence of some signs of life in your more cyclical areas of the economy as stay-at-home orders have been relaxed. And if the economy does start to take off and maybe those earnings estimates are a little bit lower than they should be from that previous chart, then it's not as overvalued as one may think. And so there's a lot of different things that go into assessing whether or not the stock market is ahead of itself or not. But overall, it's really all based on the premise that is this recovery happening sooner rather than later? And the market right now is saying that, this is almost over and this should be done soon, and we should start taking back off again. So overall, the market's assuming that there will not be a second wave of the outbreak and that consumer spending will return to pre-COVID-19 levels in short order. So overall, I would say that the market is really priced for perfection here. If you do see a second wave outbreak, or if consumer spending does not come back as strongly as the market expects it to, then I do think you could see a pullback at some point in terms of the market, because we have had quite the run. So looking ahead, what are we watching closely? While the Federal Reserve and policymakers have acted in record time and scale to try to lessen the economic damage, ultimately the antidote for the current crisis is more widespread virus testing and eventually a vaccine. Until widespread testing or vaccine is available, social distancing measures will probably be with us in some form, which will keep any economic recovery subdued. And so the longer a quarantine lasts or the stay-at-home orders last, the slower the economic recovery will be. The other thing we're watching closely is that pre-pandemic geopolitics are returning to influence global markets, even as the world continues to struggle with COVID-19. So recently, there was a new round of disputes focused on financial flows, technology, and human rights, and that has raised concerns about a reemergence of tensions between the US and China. And additionally, civil unrest continues, which is causing some businesses to shut back down and raising fears of an emergence of the coronavirus. So these are all things that we're watching closely, that given that the markets right now seem to be priced more for perfection, and that the market is discounting that this current economic drawdown will bottom sometime in the next 3 to 4 months. If we have another setback, such as a reemergence of coronavirus, or if tensions with China really start to rise, that could cause a pullback in the markets quite quickly. And so we're watching all of these measures very closely. So what are we doing for you as our clients? Well, as I hope I've illustrated on this quick market update, the relationship between what we view as lofty stock prices and expectations juxtaposed against historically bad economic activity is challenging. There's a lot of uncertainty with regard to the public health crisis. And so because of this, we're maintaining portfolios that are broadly diversified and have the potential to perform well under a range of economic conditions. We are not sounding the all clear just yet, but rather we're being very prudent with how we deploy capital for our clients. We're maintaining a focus on high quality companies that are likely to be resilient regardless of what happens with another outbreak or additional civil unrest in the United States. And additionally, we continue to rebalance portfolios opportunistically to take advantage of market dislocations. And many portfolios have rebalanced in the last 2 weeks to, again, sell down some of those securities that had really run up in value and redeploy some of that capital into the more underpriced sectors that we're seeing right now. So as always, we will continue to watch the developments closely, and we'll make changes to the portfolios as warranted. Please reach out to us with any questions you may have.